How's it, Mzansi? You are listening to Farmers Inside Track, proudly brought to you by Food for Mzansi. My name is Patricia Tembo, your host, and welcome to episode 551. So today we're looking at farm insurance. This episode is definitely going to be practical and informative as we welcome Lunga Njara, who is an agricultural economist, and he's also Land Bank's Insurance Strategic Partnerships Manager. Agricultural farm insurance can get a little complex, so fortunately we have him unpacking everything you need to know as a farmer to make informed decisions when it comes to insurance. Lunga Njara, welcome to Farmers Inside Track. We're glad to have you on today's episode.
Thank you, Patricia.
So Lunga, you are an agricultural economist by profession, and you are currently manager of strategic partnerships at Land Bank. But we have you as our expert on today's topic of, farm insurance, because you have about 8 years experience in agricultural insurance. So for our listeners who aren't familiar with you, all the work that you do, could you please expand, on the work that you're involved with within the agricultural space?
Well, I've been in the insurance space for 10 years this year. I don't know how I found myself here, but I'm glad that I'm in this niche space. My role at Land Bank Insurance, which I joined about 18 months ago from sometime in the past, I'm responsible for strategic partnerships within my space. So really my role is around business development as well as farmer development from my space. So what I'm tasked to do is to find the right partners within the agri value chain and see what synergies can we draw from each other and ensure that we sort of drive farmer development, transformation, and agriculture development holistically to the right spaces. So my role is really around those elements.
Thank you for sharing. And of course, our topic, navigating farm insurance or agricultural insurance. Maybe to just, set the scene, create context, and just brief background on what insurance is. Could you provide an understanding for farmers or whoever's listening who might not be clear on what insurance is and how it ties into farming?
Insurance is a risk transfer mechanism. And when you talk about risk management, then you can't really leave out insurance because it's just one element of risk management. Some of the farmers or even the listeners might be aware that when we talk about risk management, we talk about you can either avoid risk or take on risk or transfer risk. So from a risk transfer point of view, that's where insurance comes in. So insurance is really for us as insurers to ensure that a farmer has the peace of mind to know that when they have planted or their assets and even their livestock is taken care of in an event that disaster strikes. So that's where we come in to ensure that you pay a little premium for us to ensure that you get a payout if anything bad happens within your farming endeavors.
And is insurance necessary though for, modern farming, especially in South Africa? Is it a necessity, would you say?
It's very much important, Patricia, I must say, because I always say that insurance is a critical business necessity for South African farmers. And I'm saying that because agriculture here operates in a very unique, challenging environment where we're faced with climate vulnerability. And that's where farmers really face severe and frequent risks or perils such as your hail, your frost, your drought, floods, and so forth. And because climate change is really intensifying these events, this makes production highly volatile. And that's why insurance then becomes very important. And I think when you look at the landscape in South Africa, there is no insurance subsidization scheme like in other countries. When I say an insurance subsidization scheme, I mean a scheme that uniquely looks at insurance, like what you would have in Kenya with the Farmer Input Support Program and so forth. And because there is no really tangible or good subsidies within the space, then farmers should treat insurance as one of the necessities within their business strategies.
And of course, when you're farming, the whole point is to generate revenue, to have income. So there's value, there's assets that are valued and produce, all of that. Which would take me to my next question, which is the different kinds of insurance that are available for farmers' needs. Maybe if you could talk us through the types and maybe how they are categorized.
Within the South African market, let me say we have at least two categories. I'm saying that because we've got the indemnity type of products and your parametric insurance type of products, which is a new and innovative product within the South African landscape. So from an indemnity point of view, you've got crop insurance, and that's divided into two. And from crop insurance, what we cover is loss of yield or the quality due to a specific peril. That would be hail, for example. So within crop insurance, then we've got what we call named peril, or some would call it a single peril, where it covers listed events like hail and frost and fire being given to farmers. Then you've got a multi-peril type of insurance, and this is a typical yield guarantee cover for all unforeseen events or natural perils. And there are some that would be excluded, right? But this type of product would need a robust historical yield data for a farmer to really qualify to get this type of product. And that's just on crop insurance from an indemnity products point of view. Then you've got livestock insurance, where you get provided an all-risk mortality type of cover for animals. And your typical animals you can get cover for would be your cattle, your sheep, your goats, and so forth. And what you would cover there really is around death due to accidents, fire, lightning, disease outbreaks, as well as specified transit risks. So this is just a standard cover that I've just mentioned now, but obviously there would be extended covers that you can get by better premium, of course. Then you've got your asset or property insurance. So within the asset and property insurance space, you get protection from your farm's physical infrastructure. That would be your tractors, your implements, your buildings, your storage facilities. And the foundational cover there will be fire, lightning, storm, theft, as well as accidental damage. And even in this space, then there are extensions that you can take out as a farmer. And I mentioned that we've got two core categories, indemnity and parametric. There's also index, or some people call it parametric insurance. It's really an innovative solution where you are just focused on a deviation from the norm. For example, during the summer rain season, if rain doesn't come, then farmers are affected from a drought point of view. Or if rain comes but it's excessive, then floods would exist and farmers still are affected. So the deviation from the norm, then the norm is that you are expecting so much rainfalls, but you get less, which triggers drought, or you get more, which triggers floods or excessive rainfall. So within that space, you still divide it into two, because you've got a yield guarantee type of cover, which is what we normally call the area yield index insurance. And that's the type of cover that would look at holistically an area, all the dynamics within that area. Then you get measured against the yield in that specific area to set triggers and so forth. But there's also weather-based index insurance, where you get a partial drought index insurance for livestock farmers against forage deficit, for example, because we don't get enough rains, then your animals' grazing ability will be affected because there won't be enough greenness, there won't be enough forage for them to graze. You also have, within that space, you have a rainfall index insurance, which is pretty much very popular for crop farmers. You also have soil moisture index insurance, which is one of the weather-based index insurances that one can truly get. But I must say also, from a legislation point of view, the parametric index insurance product is not yet legislated in the Insurance Act. So whoever wants to sell that product should get the green light from the regulator.
You broke that down very comprehensively. So there's a lot that you've said, and I'm thinking, in a farmer's shoes now, they know that they need to get insurance. How do they go about this? What do they need? What information do they need to have about their farm? What do they need to know before going to an insurance broker or to an insurance institution where they can get insurance or cover? What do they need to know? What do they need to have ready?
That's a good question, because often enough you get a call from a farmer and they say, look, I need cover, I'm planting maize, and it ends there. Then you ask yourself, does the farmer really understand their unique risks? What kind of cover are they looking for? At what level do they need cover? Is it a break-even level, or is it a market value level, or they just want to cover the credit that they would have received from a financier? So I think the most important thing is you should get a broker as a farmer, because most of the insurance companies within the South African landscape intermediated, meaning they sell insurance products through brokers. That's the case with us is Land Bank Insurance. So preparation is then key to getting that accurate and cost-effective cover. And in order for that to happen, then one thing that you should get first is to gather accurate farm data. Especially for crop insurance, for example, you should have GPS coordinated farm maps outlining the individual fields that you want cover for. This is crucial for us and for you as a farmer for precise risk assessment and for claims point of view. Because, for example, Patricia, you would agree with me that you have 100 hectares, but within 100 hectares, you've got many fields. Say, for argument's sake, you've got about 10 fields, but only one field is hit by hay. Then if you've insured for 100 hectares, how will an insurer know that this is the affected field and I should go and assess that particular field? It could be that you decided not to insure that field, but insure the other fields. So GPS coordinates become very important in that space. You should have that first when you even speak to your broker. Secondly, you need to define the current season's plan. What do you plan on doing in that season? How many hectares are you expected to plant? And if you have livestock, how many livestock do you want insurance for? From your crop perspective, which crops are you going for and which crop types, animals, which breeds are you looking at? And what is your planning dates if you're in the crop space? And how much are you expecting to sell your maize or your sunflower or your soybeans for? And that would be your commodity prices, because those form basis of the value that you want to insure as a farmer. I think as we speak, we'll break down more what constitutes a sum insured, or what is a sum insured, and what constitutes towards the total value that a farmer should actually look at in terms of insurance. Inventory, if you've got assets, your tractors, your buildings, your implements, and so forth, you need to prepare that detailed list of your major machinery that you'd like to get cover for and their current values. And in that space, then you need to understand two things. You can insure at the replacement value of your machinery, or you can insure at market value. So I always advise those that I talk to that try to look at the replacement value than the market value, because sometimes the market value would drop. And by the time you want to have your car replaced, for argument's sake, then what you are getting as a payout from an insurer is not enough for you to buy a similar car. But when you go for a replacement value, you guarantee that whatever car you get would be at the same level as the car that you have lost. So replacement value is usually what I advise people to look at. And if you are in the livestock space, you obviously need to have enough livestock details. For example, for livestock insurance, we want to understand how many livestock units you want to insure, the types, the purpose, is the dairy or a beef or a breeding cattle, and what is the age of those cattle or sheep or goats. And you also need to understand the financial position, because the broker would ask you, what is your budget? You need to be able to tell your broker, this is how much I'm willing to pay. Then the broker would tell you whether you'd get sufficient cover or you won't get sufficient cover from that. Then you start the discussion from that point of view. And it's important to keep all your administrative details ready also. Your registration documents, your tax numbers, your preferred payment methods, and have a clear understanding of the required insurance period also. So these are just some of the things that you should prepare before you even talk to your broker, before you even look to have cover.
So once the farmer has, they've identified a broker and they have these things ready, you've mentioned, accurate farm data, which would include GPS coordinates, a clear production plan, asset inventory, and the administrative documents that you just spoke about now. all of those are in order. I have identified an insurance broker, but I think farmers most will understand that insurance brokers are also selling a product. So as a farmer, what am I listening for? How do I compare between different options that are available to them? Maybe if you have any tips for that.
So as a farmer, one thing you should know is you should understand your unique risks. One, you should know what your budget looks like, and you should know what is the immediate need within your farming space. And that's why I always say you need to do your own risk profiling before you even talk to the broker, before you even talk to the insurer. I think that's very much important because otherwise, you end up accepting whatever the broker gives you. So asking the right questions to the broker is critical in you ensuring that you've got the right cover, which would cover you accurately and adequately to ensure that you move from space A, from point A to point B. What I mean by point A to point B, I mean insurance should place you in the same position you were in when disaster strikes. So if you take cover but you become worse off, then that was not a good cover. And if you seek to profit from insurance, then that's not a good thing to do because you end up paying more premiums, and at the same time, sometimes you might not even have a claim. Then you treat insurance then as a grudge purchase, knowing that I should have not paid more, or I paid more, but the claim didn't come because there was nothing to claim for. So it's important to ask those questions and have all of that in mind and understand the key principles of insurance.
And what are the key factors that influence premiums when it comes to, for farmers, the main things?
So I would have to break that down into the different categories of farmers. For example, what would be applicable to a crop farmer might not necessarily be applicable to a livestock farmer. For crop insurance, for example, understanding the area exposure, or let me say the location and environmental risk, because those are the uncontrollables, and that would constitute of the area exposure history. What is the historical risk profile of that district for hail, for frost, for drought? Because this data directly then informs the insurer's base rate. So a base rate is the minimum rate that an insurer would charge you in order for you to get cover. So conducting that holistic farm risk audit is very much important as a farmer. Secondly, you need to look at the specific farm location. Are you in a known hail belt area, or in a flood-prone area, or in a drought-sensitive region? Because the GPS reference maps are non-negotiable for us as insurers in terms of assessment. So that's information that should be put forth. And from the production and financial factor point of view, which is then the controllables, if you look at the crop type and the susceptibility of that crop to the insured peril. For example, when you look at sunflower, when you look at maize, and you bring forth hail, hailstones will most, at the same frequency, will destroy, a sunflower crop quite easily than it would to a maize crop, for example. So how susceptible is sunflower to hail compared to maize to hail? So that's what we look at. And all of these factors, then we call them factors that contribute towards the rate, because the rate is the portion of your sums insured that you would be paying, right? So in order for us to get to the accurate rate, we need that data. So we'd be looking at all of that. Your historical data is important also, especially for products such as the multi-peril crop insurance, which is very much dependent on historical data for at least 5 years plus, at least, because that then sets the yield guarantee to say at what yield guarantee what trigger should we put forth for this particular farmer in this particular area, given their historical data. The claims history, Patricia, is quite important also for farmers because the claims record can lead to discounts, but a poor history increases your risk rating. But apart from the location and environmental risk and production and financial factors, you also want to look at the policy structure, the choices thereof, and these are the levers. Because I did earlier on talk about sums in short. So in order for a crop farmer to understand the value of their field, they need to look at what yield am I expecting here. For example, I'm expecting 5 tons and I'm producing maize. At what price will I sell my maize? I will sell each ton at 3,000. So what is the value of this maize in this 1 hectare? Then it becomes 3,000 times 5 tons, which is 15,000. So that's the value you would want to get cover for. So you can control these by working with the yield and the price. You might say, look, I can afford so much, so I want to take my yield to a 6 tons, for example, because that's what I can get. Or I want to take my yield a bit lower to a 4 tons, but I want to increase my price to this level, because all of those would contribute towards your sums insured, which is the total value. And then your premium then would be calculated according to that. But what also contributes towards the premiums is the deductibles in crop insurance. A deductible then can be excess, or it can be a franchise. So I always say this is a critical financial decision, because an excess reduces your premium, but it is deducted from every claim that you'd have as a farmer. But a franchise, on the other end, would set a threshold. Only losses exceeding it are paid in full. So franchises offer better protection, but at a higher premium. Let me make a simple example. You've insured your 1 hectare worth 15,000 and your excess is 10%. So what that means is, for losses not exceeding 10%, you won't get a claim. It means that. So if your losses then become 20%, you only get 20% minus 10%, which was the excess. Because remember, with your excess, you pay 10% less on premiums. So the insurer says that 10%, then you keep it in your own pocket and would only start paying, if you have total losses, would pay 90%, not 100%. But a franchise is different, because a franchise says you still pay the agreed premiums. And from paying those premiums, we give you a franchise of 5 or 10%. Say a franchise of 5%. What it means is that if your losses are 5% or less, then you don't claim. But if your losses are 10%, then you get 100% payout, meaning you get to claim all that 10% representing your losses. But the premiums with the franchise are quite higher, compared to an excess structure. But now when we move to a livestock cover, we want to know the animal and the head profile. What type of animal do you have? What breed and what age are these animals in? Is it dairy cattle? Is it beef breeders? Is it goats? What is the age profile? Because this significantly affects the risk and the premium. And what is the purpose then of these animals? That's important. If it is a breeding animal, if it is a dairy or a feedlot or operation that you are in, it's important that the quality of your head health and management system becomes factored in, because that's a key rating factor within our space. The location is also equally important, because there are prevalent diseases in certain areas and the predators in some areas. So we need to understand that risk profile. And that's data that insurers do have. That's why they would have a base rate for a particular area. And for assets, it may be a bit less complicated. For asset, because we want to understand then what is the value of your tractor. So that asset inventory and the values are very much important. And the exposure to perils also come into play, because we would assess your assets vulnerability to fire or lightning or theft or whatever peril you've taken. And also we want to understand, where are you based? What is the location? And what are the security measures to ensure that there is no theft within your space? If, for example, you've got security guards within your farm, then in terms of theft, your rate might be slightly lower than someone who doesn't have them, because you've got something in place to ensure that this doesn't take place. But when you look at agriculture in totality, there are universal business factors that we look at, your total financial exposure as a farmer. Because if we are to pay you and your exposure is 10 million, that means you are a high risk farmer from our end. So we want to understand that at the very beginning. So the sum of the total value of your insurable interest becomes important, because that would give us an idea of your potential livestock value or your asset replacement cost or your potential crop revenue. And that becomes the total risk exposure. That's why insurers even have reinsurers within their space where they cede certain businesses to them, because if your balance sheet as an insurer is, for example, 1 billion, but your total exposure is 10 billion, that means you have total wipeout. You can't pay claims of 10 billion because your balance sheet says you've got 1 billion. That's why we have then reinsurers who come into play to say, look, give us 10% of that business, then we pay 10% of claims because we'll be getting 10% of the premiums and so forth. So there are different reinsurers, within each insurer. Then you need to understand also how insurance calculate premiums. I think that was the second question. We've got what we call a loss cost in insurance. So the insurer is expected to pay out based on, one, the historical data for your district and crop. Right. So that's what it means. And the primary rating factors in that space would be your crop type history, your area exposure, and your personal loss history. And the risk specifics then would be the exact location, the spread, the distribution of your crops or livestock. So what we'll look at then is to say, from all these rating factors, what rate are we giving you? If, for example, we are saying you've got a rate 3% in your maize farm, say per hectare you were expecting 15,000 rands. Once you sell your 5 tons at 3,000, what we give you is a 3%. So a 3% then becomes your premium. So it's 3% of the 15,000. So 3% of 15,000 would be around 450 or so per hectare. And if we have 100 hectares, then it's 450 times that 100 hectares. So these are just some of the elements that we look at. But as an insurer, because we want to protect our investments the same way a farmer wants to protect their investment, we don't do macro analysis only. We do macro analysis also. That's where we talk about what the industry is all about, the climate context, and so forth.
As you said, the factors differ from farm to farm. So I'm assuming this is something that an insurer would break down for a farmer before they take the insurance. Is that correct?
That's correct. So usually it's the broker that will be doing that, because insurers have got to train brokers on the products. If there are changes in a product in a particular season, then each season there's a mandate from the regulator that a broker should be trained on the product and should pass an assessment before they sell that product to a farmer.
And Lunga, of course, you have over 10 years of experience within agricultural insurance, and I'm pretty sure you have seen farmers making mistakes or falling into pitfalls. So what are some of these pitfalls that you've seen farmers fall into, and how can they be avoided?
One that took place last season was underinsurance. So that basically means insuring for less than the value because you want to save on premiums. But then again, that would lead to inadequate payouts. For example, if your break-even is 1,000 rands, but you choose to insure for 800, that means the next season you won't have enough to even plant. Because I did say at the beginning that most of insurance is to place you in the same position you were in before disaster strikes. And I think for farmers to really avoid some of these things, you need to base your sums, in short, on realistic production costs or asset values or even livestock values if you're a livestock farmer, and not just thumbsuck a number and say, I want cover for this amount. Know how much cost you've incurred as a farmer per hectare if you're a crop farmer, and at least get cover at break-even level. And if you want to push for market value, but at least get insurance at break-even level, because we treat insurance as an input cost within the South African space. In fact, worldwide, insurance is an input cost. It should not come as an aftermath. Secondly is lack of understanding or not understanding the policy mechanics, because for some, insurance is a grudge purchase. Right. So they take insurance because Land Bank said, hey, we're not giving you any money. We're not financing you without you getting cover. You need to get cover. And they say, okay, let me get a broker, give me cover, I want insurance cover. And it ends there. But they don't understand the mechanics, what you're covered for and what you're not covered for. And some farmers would even confuse what an excess is from a franchise. So you need to understand all those things. But that doesn't just happen from a farmer asking a broker what these elements are. As a farmer, you should get that clear written explanation with examples. Like when we began the discussion, Patricia, you did say that explain the best way you possibly can. That's the case with farmers also. Talk to me as if you are talking to a grade 10 learner. Explain what a franchise is, explain what an excess is. In order for me to avoid going under insurance or over insurance or not even understanding what I'm covered for. For example, a farmer would get cover for hail, but when drought comes, they call you and say, hey, I've got a claim. I haven't received rain since December, but you're not covered for drought. You're only covered for hail. So that becomes important. And also missing key coverages. I think that's what I talked about, hail, for example, but neglecting other relevant perils to your operations. For example, choosing hail but not taking fire when you know that you are exposed to fire. So it's important as a farmer to conduct that full risk analysis with your broker. And I always say that before even your broker gets into your space, make sure that you understand why you need insurance, because everything lies in the why. Everything lies in the why. And some farmers take cover a bit late. I got a call last week from a farmer in the Eastern Cape, and they say, look, it hasn't rained in the Mtata area for quite some time, since December actually, and we had planted already because it was promising in November, so we decided to plant. Is it too late to take insurance now? And my answer to them is you would need a drought cover. But then again, there is no drought cover at this point in time, unless an index type of product. So it's important when you are planning, that you will take cover. Because now, even if you take insurance now, compared to a farmer who took it in October, you will still pay the same premiums. You still, because the risk is the same, right? And for farmers to avoid that, they need to initiate cover well before planting or the risk season starts. And also, data is important within the insurance space. Data is key for us, especially for certain products such as your multi-peril crop insurance. We need to understand those in order for us to set the guarantees. So you should always use accurate and data that we can verify as insurers. And what I've seen within livestock is farmers' misunderstanding of the all risks element within the cover. So they always assume that it covers everything. But insurance covers everything that happens by chance, not things that can be done by someone else. So policies exclude controllable losses. For example, poor management. You can't get cover for poor management or diseases that you can prevent. You won't get cover for that. So it's important to really read the unchangeable causes of loss, because there's always a list in your policy wording, in your policy document there. And before you even talk to that broker, it's important for you to know what you want cover for. And you ask the broker relevant questions to say, oh, okay, I see this is not listed there, but it's a major risk. How do I mitigate this risk? So I think those are just some of the pitfalls that I've come across within my tenure within the agri-insurance space.
And of course, in farming, risk is always a factor. So when a farmer does purchase an insurance product, there's a chance that they will need it at some point. So now disaster has struck. What are the immediate steps a farmer should take to ensure, that the claims process goes smoothly?
One, your policy will tell you that you need to mitigate further damage, say in your assets, for example. So you should take reasonable steps to prevent additional losses. For example, you can secure your damaged structures, and that's required by the policy, because you don't want to have more losses than you already are experiencing now. If you can do something about it, then do something, because remember, there's the moral hazard element to risk management or to insurance. So sometimes moral hazard is controlled by excesses, meaning you pay a certain fee before you can claim, or you absorb certain percentages of losses before you can claim. So it's important to take those steps to prevent additional losses. Then upon doing that, you notify your broker or your insurer as soon as possible and report the loss and initiate that formal process. Then upon doing that, you need to document everything thoroughly. Take extensive photos and videos of the damaged assets or crops if you can. Make sure that you don't destroy or disposed damaged items until an assessor visits. Because an insurer will send an assessor to go and do loss adjustments in crop insurance or loss assessment, right? To say to what extent are the losses, what is the expected payout for this particular farmer. And you need to keep records of all the rated expenses as a farmer. For example, your emergency vet cost, your temporary repairs, those are quite important. Upon doing all of that, make sure that you work very closely with the assessor. Be very close with the assessor. Provide the independent assessor with all the necessary documentation that they need. It could be the maps, it could be the records, it could be the invoices, and guide them to all the affected areas. If you are a crop farmer, for example, you know which fields are affected. Guide them through all of those. And try by all means to understand and review the assessment before you sign it. Because an adjuster or a loss assessor will determine the loss using methods such as percentage loss for hail damage, for example, or yield loss for multi-peril crop insurance, or quality loss for fruit farmers. So you should review their report carefully before signing it. And because this report would inform how much payment you will be getting as a farmer.
We're speaking of the different enterprises when it comes to farming, but I think a question that a lot of farmers may have, especially emerging or under-resourced farmers, is agricultural insurance accessible for them? Are there products that are catered to farmers who have lower turnover when you put it in context with, commercial farming? So is insurance accessible for a small-scale farmer?
I think it is compared to when I started. But obviously, for emerging farmers, it's important to understand one, what prevents them from accessing insurance. Because I'm a great believer that if you want to solve the effects, then you let the root cause lie there unattended and they will still prevail. If you solve the effect today, then tomorrow you're still facing the same problem because you did not address the root cause. So usually a huge part of the access to insurance for emerging farmers lies on two factors. And those factors can be divided into the demand side growth challenges, where the lack of awareness of insurance solutions by farmers, and some farmers don't even know that there's agri insurance. Depends on where you are. And having joined the space in 2016, already, I didn't know much about agri insurance. I don't want to lie. I didn't know much. But it took me to be in this space for this long for me to understand agri insurance. You can only imagine for a farmer, under-resourced farmer who is dependent on state grants or Planet Finance or whatever support they're getting from whoever. So you've got those demand growth challenges that we need to understand, the awareness of the solutions. And two, there are farmers that are aware that, look, there is agri insurance, but they don't know how these products actually work. And some who do know how the products work can't afford the products. So you've got to look at the demand side growth challenges when it comes to emerging farmers. You also have the supply side growth challenges, which then talks to us as insurers to say there are high transaction costs, which would push up the premium for farmers who can't even afford insurance. Then you've got regulatory barriers where we say, hey, this index insurance thing of yours is not an insurance product. It's a product rather than insurance, because it has elements of being an indemnity product and other elements of being a derivative. So where does it fall? That's why you still need to talk to the regulator, get approval from the regulator before you pilot or sell this type of product. Then you've got issues around inadequate modeling because there is not enough data on developing farmers in certain areas. So the farmer would come to you and say, I want to insure my maize for 7 tons per hectare. And you don't have data in those areas as an insurer. So how do you then know that this is a marginal area or an area that can really produce the 7 tons per hectare? Without that data, it's pretty much difficult to have the right product for the emerging farmer. Then lack of innovation also, because we're talking about Hill, we're talking about MBCI, we're talking about all other products. But can we talk about innovation then to say what product can we sell to a farmer and which channel can we use to sell that product to a farmer? Which brings me then to the last point to say the absence of adequate distribution channels because you're dependent on the broker only. But can you look at aggregators? Can you look at selling insurance online for the younger farmers and so forth? So my answer is there are those challenges, but in so many ways, there has been progress for developing farmers to have access to insurance. And one of those ways is through the aggregation, as that is the case with the likes of Sagra, your Grain SA, the Khodiso Development Fund, Kagiso Trust, Ukhanyo Farmer Development, Farm Soil, and so forth. So these guys, they consolidate all these farmers and give them what we'd call a group kind of cover. Farm Soil would come to us and say, we've got so many farmers that we are supporting and one cover for them. So you know exactly that Farm Soil has done the groundwork of consolidating the farmers and the premiums will be paid to us. So that's one way of farmers to access insurance. The second part is really around the index insurance product that we are running as a country. I believe there are two insurers, including ourselves, that are doing that. So the primary innovation driving accessibility in index is the fact that it addresses the traditional barriers that you would get pretty much from your indemnity products, your health cover, your MPCI, and so forth. Because what index insurance does is to lower costs and the complexity there, because it does that by eliminating the costly individual farm assessments, which in the long run will then lower the premiums of farmers because you don't have to send an assessor to do a loss assessment because you still, as an insurer, you still need to pay that assessor. But at the beginning, it won't be as cheap as people perceive it to be because you still have to have systems in place. You still need to run pilots. You still need to have enough volumes and so forth. There's also with index the fact that it overcomes data gaps. Because it doesn't require extensive individual farm history. And emerging farmers particularly don't have that farm history. When I say farm history, I mean production history. So index insurance would look at a particular index or a parameter. So the reason why it's called a parametrics insurance because we're looking at the parameter, which is an index, which is a measurement. We measure rainfall, measure temperature, we measure soil moisture. So and the other thing about it is the speed and the transparency. Because when we talk about payout from an index point of view, the idea is to have them automated. Meaning the moment it doesn't rain for a certain period of time, there is a trigger from the satellite that drought has struck in this area, then a payout should be made to the farmers. And there should be regular reports that are sent to farmers to say, oh, this is the state of the soil moisture in your area. This is the state of rainfall index in your area. And it helps that with index insurance, you can also bundle it, with potential credit providers or input suppliers or even advisory services. So you don't necessarily have to sell to an individual farmer, but you can sell to a group of farmers that are supported by that input supplier. And I think for entities like ourselves, as in bank insurance, we have a mandate to develop inclusive index products. That's why we've done partial drought index insurance, we've done error yield index insurance, because we need to align to the national transformation and resilience goals. And I think there's more that is done for farmers to access insurance. And the education element becomes very important also because at the beginning, we talked about the demand side growth challenges, the supply side growth challenges. But that all goes down to education, in my opinion. You need to educate farmers about the risks, the benefits of insurance, what you should be doing and what you should not be doing as a farmer. Because often enough, we've seen farmers also taking cover this season because it's going to be a very dry season. They take cover because they are guaranteed payouts. Then 2 years down the line, it's good conditions and they don't take cover. And remember, when you take cover in bad seasons for insurers, that means your claims history goes up. Your loss ratio, if it's more than 65%, then you're a high-risk farmer. Say, for argument's sake, over a period of 5 years, we've insured 2 times because it was dry in 2 years. but your loss ratios are over 100%. But in the years you should have insured, where there wouldn't have been claims, which have contributed towards lowering your loss ratio and your claims history, which will ultimately, in the long run, ensure that you have a better rate compared to someone who has been entertaining adverse selection, where you insure when you want to claim. So you're very much affected. So education becomes important in this space for them to access. So there are quite a number of factors, Patricia, that contribute really to the access for farmers. There's no blanket approach to say you need to do this and that and that. Farmers need to play their part also.
And beyond insurance, because of course insurance is a risk management strategy, how else can farmers implement risk management strategies? As you said earlier, that it does obviously then affect or influence the premium that they're getting or the rates that they're getting when, they have other risk management strategies in place. So maybe if you could just briefly mention some of the strategies that you have seen be beneficial when it comes to insurance.
And now you are forcing me to get into your space. Obviously, you'd want to categorize also the strategies into your production strategies, your tech-driven strategies, or your knowledge or community-based strategies. What I've seen often enough is farmers having hail nets. Some farmers are really increasingly using the nets to protect their crops from hail damage. And these nets are installed because they're not cheap for high value crops. And they have what it takes to reduce the impact of damage to those crops. But what I like about them is really the benefits that they come with, the protection from hail being the primary benefit, because they can absorb the impact of the hailstones and prevent them from striking directly the crop or the plant. And a cost-effective solution then for some farmers, especially in the long run, because you don't need to take a hail cover when you've got hail nets, right? So while the initial investment then may seem a bit high, the long-term saving from the reduced crop damage and the need for emergency repairs can outweigh the cost, in my opinion. And I've seen also versatile protection also that becomes a benefit from these hail nets also, where in addition to that hail nets can also protect against strong winds, the birds and other environmental threats. So these do work, but for some farmers, diversification become very important. And to get a bit deeper into your space, implementing your CSA, for example, climate smart agriculture, or looking at drought resistant crops or conservation tillage. These are just some of the things that farmer can look into, and having mixed crops or livestock just to build the natural resilience of your fields. And then within the tech space, we've seen some farmers really being tech savvy, where they've got weather apps now, they've got soil sensors, they've got precision tools, just for better decision making and to build that reliable farm data history. I think that helps also. And some farmers do self-insure, knowing that yes, you've got your farm and you're making good money from your farm, but then again you've got other businesses, and you know that hail is not really a risk in your area. It comes once every 5 years. So you can self-insure as a farmer, but for emerging farmers, sometimes a bit difficult to do that, because self-insurance means you need to have enough cushion for you to bounce back the following season. And obviously, as an insurer and a salesperson, I don't like those who self-insure. And also having those discussions with the farmer organizations, belong to a farmer organization or at least a co-op, where you share knowledge just to maintain that strong relationship, with the knowledgeable people, including the brokers, for ongoing advice. I think those are just some of the strategies that I've seen and some of the strategies that do work.
Absolutely. And Lunga, you've shared so much information in this podcast, but if there's one single thing, the main takeaway you'd want a farmer listening to have, what is that when it comes to insurance?
Each insurance is a strategic business investment. For resilience, you need insurance. Don't see it as a crash purchase. Engage with it proactively and ensure that before the season starts, you've thought about insurance. You've had engagements with the broker, told the broker your plans. you truly have to understand your data as a farmer, because data is king for insurers, data is king for farmers too. So really understanding that through production history and the cost and the risk you're exposed to and the product, what it covers, what it excludes, its mechanics. Make sure that you understand those. But more than anything, just treat insurance as a strategic business investment.
Thank you so much to Lunga Njara, who is Landbank's Insurance's Strategic Partnerships Manager. And if you'd like to read more about the topic that we spoke about today, you can definitely visit www.fruitformzansi.co.za. The article is there. And that brings us to the end of this episode. Remember to subscribe to our podcast on your favorite platform. From myself, Patricia Tembo, our technical producer, Megan van der Vent, and the rest of #team Food from Zanzi, thank you for listening and keep growing with us.